It's 12 o'clock. Lorraine, do you want to get us started?
Sure. Thanks for joining, everyone. Hopefully we'll have a few more join as the time progresses here. Very pleased to have Alicia Shaul present to us today. Alicia and I first met as part of a networking group that we had lunch about, I guess, once a month, and she's still part of that networking group, I believe, and so very pleased to have met her in that venue. And then she joined NABO. It's been about a year, maybe just over a year. Alicia also went through the Business Institute class, and so is definitely supporting our NABO sisterhood. And so very pleased to have her here today. She has many years experience running her own business. She just shared with us that she has a staff of 6 full-time and 2 part-time, I believe. And so not only is she running her own business, she's got a staff that she's in charge of there, and the business is continuing to grow. So with that, I'm going to turn it over to Alicia for her presentation today.
Awesome. Thank you so much. I appreciate it. I can go ahead. I was going to say, for those who don't know me, I'm Alicia Shaul, and I am the owner of Shaul Associates, a full-service public accounting firm. Our specialty is actually working with closely held businesses and providing strategic planning advice throughout the year for not as much like what Lorraine does in the EOS model, but more in a tax advisory, strategic planning, accounting, payroll, and how all of that works together so that we can help. We provide planning advice for individuals too, but we find that it's the businesses, the closely held businesses, that really use and need that strategic planning advice so they don't get clobbered in taxes at the end of the year and you get surprised with a big bill to the IRS. So we want to make sure that we're always working throughout the year to find ways to identify that you're paying yourself first, and that we're intentionally planning and utilizing our transactions as we're going so that we're paying the least amount of taxes and trying to create a tax-friendly environment for you and for the business owners. So with that, I'm going to go ahead and screen share. And how long do you want me to speak so I can make sure to cut myself off? Because sometimes I can get busy answering questions.
Yeah, do you want questions as you go, or do you want to wait till the end?
I can take questions as we go.
Okay,
that's fine
so
with me.
If you have a question as she is speaking, please put it in the chat. And Katie and I will monitor the chat and make sure, and Ashley will monitor the chat and make sure that we escalate those questions. But I would think if we could be done with comments by about 12:40, that would give us some time for some questions and dialogue.
Sure. Awesome. That sounds great. Alrighty. So share. Okay, awesome. So in part of what we do in our strategic planning, I'm kind of giving you one of our modules that we have an advisory kind of educational module classes of topics that we feel business owners need to know. So I thought when I was asked to speak that this would be a good module to share with people for the promotion on that. Okay. All right, so when we're looking for our planning and our strategic planning advisory services on this, when we're tax planning and looking at how we're going to structure things, it's good to know how income is taxed, because sources of your income and your revenue are not taxed equally in the eyes of the IRS. Tax laws were created and designed by the wealthy and by business owners for business owners. And unfortunately, especially over the last several years, the W-2 employees are the losers in the tax law and the business owners are the winners. And the wealthier people are the winners. And it's just the way, whether it was trickle down economics coming out of the Reagan era or out of the Trump, tax legislation generally is not as favorable for active the workers. So there are basically 4 levels. If you can there are 4 levels, distinct levels in categories of income. And the highest taxed level of income is called active income. And in the active income, that is basically work that you do. You work for your dollars. So this would include W-2 wages. It would include self-employment income from a Schedule C sole proprietor, or it would include income from a general partnership. And the reason why these are taxed, this is how it's penalized so much, is that it's not just federal and state income taxes that at the highest effective tax rate that you're paying taxes on this type of income, but you're also hit with your Social Security and your Medicare taxes. And so, like, for example, for a Schedule C sole proprietor or a general partner, it's a little bit better for your W-2 employee, but basically you're paying taxes on 100% of that income on the bottom line, and you pay, for the self-employed people, 15.3% self-employment tax, plus federal income tax, plus state income taxes. And so what's frustrating, especially for people in the sole proprietor or the general partnership category, is you can end up with 30 cents of every dollar, 30 to 40 cents of every dollar going back to a governmental entity. And that really stinks, because why are you in business if you have to give back a third of everything that you make back to a governmental entity? And that's on a low end. You know, it could be, yeah, if you're in 15% federal, 5% state, and another 15%, you're at 35% of taxes. So the active income is always the category of income that we're always trying to move out of. So when we're doing income shifting strategies, our goal is to always move downward in the categories. So this is the least favorable category, is your active income. The next category of passive income actually comprises technically two subcategories. One of passive dollars would be bottom line profits from an S corporation. It would be rent income, royalty income, other sources of you've invested your money and it is now paying you back. Portfolio income is the other subcategory of this, which is basically your interest, dividends, and capital gains. If the good thing about the passive income is under the 2018 tax legislation, if you're making money in the passive category, and it can be if you work in your rental properties, or you have passive income coming in through your, you have the bottom line profits flowing through on a K-1 from a partnership, not necessarily a partnership, but limited partner, or mainly your S Corp. You only have to pay taxes on 80% of the bottom line profits. Now, your Schedule C sole proprietors and general partners also get this tax break of 20%, but they get killed on that. It's negated by that self-employment tax, by 15.3% self-employment tax. And when we get into the interest, dividends, and capital gains, especially if you hold dividends for an investment for 5 years, and you get the long-term capital gains rates where you hold it for a year, you're always going to pay taxes at a lower rate than what that same dollar would get taxed if it was in the active income. So we're always looking at ways to find an optimal blend between report what we have to for active income, but we really want to try to move it down into the passive income category as much as possible. Because as we're saying here, a worker can never catch an investor. We want to try to get as much of the income sources as we can in the lower taxing, being taxed at a lower rate. That's the main thing, or bypassing tax. Of course, the best way of having income is tax exempt income, but that's very limited for where your sources of tax exempt income is. There's very limited options on that. So when we're looking at income on the reasonable, if you're like an S corporation, where we want to not pay that self-employment tax on our bottom line profits, which is that 15.3% self-employment tax, but the IRS says we have to pay yourself a salary. What we're looking at on this, and I know I feel like I'm talking kind of jargon, but basically when you have you own a business and you have your pie, That's what you made. This is your bottom line. You have your money coming in for your revenue, and you have all your cash going out for paying your company expenses, like your phone and rent and wages and all that, and what's left on the bottom line profits. What we're looking to do to move down these income stratuses is, if you have your pie is 100% of your bottom line profits, the IRS says we have to keep a portion of that pie in W-2 wages taxed at the highest effective rate, but they also say it just needs to be reasonable, but they don't define reasonable. Whenever I've looked through the court law of reasonable compensation cases, the amount that they say is reasonable when the courts have had to define what should have been paid, it generally comes in about 30 to 35% of that pie should have been paid out in W-2 wages. Of course, there is no bright line test, but the idea is you don't want to be the lowest hanging fruit, but you also want to capture the tax savings for the set. We want to have, you want to capture that tax savings of not having to pay that Social Security and Medicare taxes and get that 20% tax deduction on bottom line profits for the businesses. And so what we're looking at on the compensation is we want to move a chunk of it in as W-2 wages, and then basically let the rest of the pie come through as one of our tax saving strategies as bottom line profits, because you only pay 80%, you only pay taxes on 80% of that bottom line profits, whereas the W-2 portion you pay 100% taxes on. Another question I commonly get is, well, then how do I take out all the money out of my company? And the answer to that is you take it out in the form of a draw or a distribution. This is your payout of the bottom line profits that you're entitled to take. That's your shareholder or your member distributions. That's considered part of the passive income category. And so what I've seen people do is just negate the benefits of their S corporation by paying out 100% of their bottom line profits and salaries, and it's the same thing as being a W-2 employee at that point, and you've lost that income shifting strategy. Another income shifting strategy is if you have someone that's a sole proprietor, but they're not wanting to go through the efforts or the time and the requirements of being taxed as a corporation or as an S corporation. Another option that people can have to shift that money out of that active trader business on a Schedule C is to pay yourself rent, because rents are not subject to self-employment tax. So what you can do is, its characteristic is it's not subject to that 15.3% self-employment tax, and you can pay yourself rent for an office in the home that you have through the Schedule C, or have a lease in case you do have building. Perhaps if you own a building and you have your business operate out of your own building, that you can have it that way. Another savings strategy would also be for paying yourself. This is a little bit trickier, and this is where I would actually defer probably to Donna, Donna Miller on that. But if you have intellectual property that you use in your business, another income shifting strategy would be to trademark, copyright your patent your intellectual property. I'm saying the wrong words on this. Donna can speak up and clarify. But to protect your intellectual property, and then you can pay yourself a royalty or a license fee off of your own intellectual property. Again, it's a better alternative than wages, because you don't pay that 15.3% self-employment tax. The key on this, though, as a caveat, is you do need to stay within what's deemed to be a reasonable fair market value for the cost of this. Another option, I always kind of jokingly refer to my kids when they were younger as slave labor. And they may or may not appreciate it. They're all grown adults now. But you have a resource, especially if you have a business in front of you or that you're working with, and you have an ability to hire your family and be, especially even children. I'll never forget when I was just starting out on my own firm in 2004, and wait, I'm dating myself. We had to photocopy a whole bunch of paper. That's when all the records, the client records, were all paper. And I was making copies. Don't get my, this has been enough. Statute of limitations. I copied my customers' records and I took them with me to the new firm. And so, and I know Donna's going to raise her head on that again because you're not supposed to do that, but I did. That was 20 years ago. And so I hired my children, and I had my 5-year-old, my 7-year-old, and my 10-year-old helping me out with transitioning my client base out of my prior firm to open up my own practice and my own accounting practice. And so I had my 5-year-old pushing the button on the copier, and he was in charge of just feeding the copier and pushing the button. My daughter was in charge of taking it off the copier, helping me stamp it. My 10-year-old was making filing folder labels, and we were relabeling everything. And I paid my kids a reasonable wage. I think at that time I paid them, like, I would say $8 or $10 an hour, what would have been for clerical work. My return got audited that year, and I was a Schedule C sole proprietor. And they're like, really? And I cut a W-2 for my kids, because when you're a sole proprietor, you can pay your child a reasonable wage, and you do not have to have any Social Security, Medicare, or any other taxes withheld. And so when I talked to the IRS agent, and I said, yep, I kept timesheets. This is what they worked, and this is what they did. It was within their functions. And it came back no change, because that's what the law said. So if you have children, now I'm not saying hiring your 5-year-olds, and 5-year-olds are not supposed to be on boards of directors. I've had people ask if they can put their 5-year-old or their 7-year-old on their board of directors, and they're going to have their annual retreat at Disney World, and wanted to know if they could get a tax deduction for it. The answer is no. But if you have teenagers, one of my part-time workers is my bonus daughter. She's 16, and I have her do all of our scanning during tax season and throughout the year. Whenever we need scanning done, she is our scanner. And so a child can, in 2021, earn up to $12,550, and they do not have to pay income taxes. Federal income taxes on that. So basically, if they're in less than that, they would not owe any income tax. And you get, as a business owner, a 100% tax deduction for the wages paid to your child. The catch on this is you do have to pay them a bona fide wage. You have to pay them cash, or check or something. You've got to pay them. If you're going to hire your kids, you can't do it fictitiously. You do need to actually cut them a check. But you would get a tax deduction for that. So part of the requirements for if you want to hire your family, it must be a bona fide work arrangement. It needs to be that if you weren't able to do it yourself, you'd have to hire it out, is generally what this says. And it must be a reasonable wage. So when I got my return audited way back in 2004, the IRS agent she kind of raised an eyebrow at me. I'm not going to deny that. But I had paid them, my kids did actual work. I kept timesheets. I paid them the money. And I cut the W-2 at the end of the year. And it was deemed to be reasonable. So for an example, on administrative duties, if the market rate in the area is $15 an hour, if they ever set minimum wage of $15 an hour, then that's what you can pay. You do have to prove that they did the work. It could be time cards, time logs, description of job duties that they provided. The money must be paid to a children's account. You do have to give it to them. It can't just be funds left in your own account. And then basically the tax savings, how much is it worth by paying that? If I just round to $10,000 that you pay a child to help, and if you're in the 20% tax bracket, then that would be a $2,000 tax savings in your tax return. And if it's money that you'd end up having to pay them, I'm always a bonus for slave labor with my kids when they were growing up. I want to make sure that they're working, and rather than me just funding all their shopping trips, I make them work for their shopping trips, and then this is the way I get a tax deduction out of the money that I pay them so that they can get the things that they want, whether it would be a car or something else. So an example of this is if the marginal rate is 32%, it would be $320 for every 1,000.
Hey, Alicia.
Yeah.
This is Kathy. Jill asked if when you're hiring children, does this apply also to LLC and partnerships?
Okay, so a partnership, an LLC, LLCs are a shape-shifting blob, so it depends on how the LLC is taxed, and a partnership does work. If you are taxed as a corporation, whether it's a C or an S corporation, you will have to withhold Social Security and Medicare taxes out of their pay. The exclusion for not having to withhold any Social Security or Medicare taxes only applies to that Schedule C, even if it is an LLC that still files a Schedule C tax return. I do believe general partnerships would still be able to get it. I would have to look that one up. I know the S Corps and the C Corps, you definitely have to withhold Social Security and Medicare taxes when you're paying your children. But there is this next tax planning strategy where there are very few of times where you can double dip in the tax law. And this next one is a double dipping scenario. Did I answer your question, Jill? Okay, thanks. So this next scenario is one of the few tax planning strategy areas where you can really double dip when it comes to paying for your children's college education. So in this tax plan and in just future planning for your kids, it's an awesome ability. So one of the areas that we absolutely love is if you are able to hire your children and you do have some sway, or maybe they've done extra work and you pay them a bonus based on the extra work that you have them do, or you cut a deal with them. I'll give you half of your cash that you put in, and the other half needs to go into a Roth IRA. Roth IRAs are an amazing vehicle for putting money into for your child's future. One of the beauties there are several beautiful attributes of a Roth IRA. One is it creates a wonderful foundation for your children to retire upon, but it also gives them the ability to help pay for college, take money out for the first time home purchase. You can put more money out, save more money in a lot of options that can be used to pay for college. It can be used to pay for a down payment on a house. And these are things that your kids, when they're teenagers, are not thinking about. But as a parent trying to figure out how to get a tax deduction for this, it comes out wonderful, because as a business owner, you get a tax deduction up front for the wages paid. And then when the money comes out, if it's used for higher education, to pay for college tuition, or to pay for first time, a down payment on a house, because it was in a Roth, these are qualified distributions for a Roth that you wouldn't get hit, the child would not get hit with the penalty to take the money out to pay for those things. And because it's coming out of an IRA, those funds are still eligible for the college education credits. So you get a tax deduction up front for all the money going in. The money grows completely tax-free, tax-deferred while the child is finishing school. And if they take the money out when they're ready, let's say they're 30 now, when they're ready they want a down payment on a house, or they need to pay for college, they can take the money out. It doesn't get hit with the penalty. And basically that's going to be, to the extent that you put in, it's going to be tax-free income that you can use to pay for the house. And like I said, if you paid for college education, you still get the college education credits, assuming that you're eligible to take them. So yeah, when you're considering this, it can be used, it grows tax-free, it can stay with the children even if it's not used for education. Like I said, you can use the $10,000 for a first-time home buyer, first-time home purchase, or a Roth can be used for the education classes, cost of tuition on that, and you get the 100% tax deduction up front. So it's a wonderful, using your children to work for you in the office is an absolutely wonderful planning strategy. One, it teaches them a good work ethic. It also, I always like getting the kids involved where mom and dad are working, especially the moms, so they can see how strong you are in working with things. And then it also provides a vehicle for you to get a 100% tax deduction up front for the wages that you're paying them. They get to learn how to manage money. And you can also use these types of tools to help get a tax deduction up front for their college education costs and have money coming out on the back end being tax-free. I'm not sure where I am on time.
We are at 12:27, so you have
Oh,
about...
I'm finished way early on this one. I'm sorry. Zoom calls never take me as long as when I'm meeting in person.
Yep. And we do have another question in the chat from Donna Miller.
Yeah.
I saw something on your slide about the timing of partner/owner draws. Do you have recommendations about that? For the timing of the owner draws, generally what we say is that it's up to management. I have some companies that like to wait until the very end and see where the profits are. To be completely honest with you, if you're preparing your financial statements, you can pay yourself an owner's draw regularly. I have people that'll just take salary for the first of the month and a draw on the 15th. They can take it sporadically. The partner draws, the only thing I will say on that is the more partners there are in the company, the more you need to discuss it and agree upon it, because it can be a bone of contention. If one partner A is taking cash out of the bank account all the freaking time, partner B is not. It's easier when it's just a one owner that can take the distribution of the profits out whenever you want, basically, because you don't have other people to be accountable to. If there's other partners in the firm, in partners, you can have your guaranteed payments that you can say, okay, I know I'm going to get it X amount every single month as a guaranteed payment for the partner. And then for the distributions on the timing, there's nothing in the IRS code that says the timing, and there's no regulations. So nobody's going to slap your hand if you take it out too frequently or not. The IRS eventually, theoretically, if you don't ever take out your draws, you can get in trouble with the IRS, because the IRS does want you to take out your profits. But usually for closely held businesses, I've never seen that be an issue, because that's how you live. So did that answer your question or not at all? Okay. I didn't see that question long enough. What tips do you have to ensure your Social Security benefits schedule is maximized to get larger amounts upon retirement? Switching from LLC to S Corp and paying a wage. Also, then there's a second question, but also, what about changes in business structure? And there is a blip on the Social Security schedule. Can you contact the Social Security Administration to raise it to what it really is for that blip year? Okay, lots of questions in that. Okay. Yeah. So yes, you can absolutely. I recommend just logging in and creating your own portal for the Social Security Administration, and then maybe you can report that blip in that, or contact them to show them a copy of this W-2 and dispute it that way, so they can give you credit for it. When it comes to Social Security, I subscribe to a different mentality and methodology. My methodology is plan on your retirement, do not plan on Social Security. We intentionally do not try to maximize Social Security.
because you can keep that money and invest it and manage your own investments and your own money, because you don't get dollar for dollar back out of Social Security. For every dollar you're paying in for all these years that you've been working for 30, 40 years, you're not getting that back dollar for dollar. It's set as a percentage. And I always recommend for people to not consider Social Security to be a bonus. You need to plan for your retirement as if it's going to go away, because throughout all the years, we don't know how long Social Security is going to be here. And if that's the only egg in your basket for retirement and it goes belly up in 2050, a lot of people are going to be hurting. And so I always recommend work with a financial planner and plan your retirement so that Social Security is a bonus and not a necessity to live. So when you're saying, how are we maximizing Social Security? I'm going to tell you we're not. We're trying to put more dollars in your pocket at the least amount of tax so that you can pay yourself first and invest it. That way you have control over your future, you have control over your retirement. Because that Social Security, what I see over the years is it's a carrot. So as Social Security gets closer and closer to going belly up, because I've been hearing about Social Security going belly up since I was a teenager. This has been an issue for years and years and years. And when I was younger, the golden retirement age for full maximum Social Security benefits was 65. I think now I have to be like 69 and a half, maybe 70 by the time I get there. Maybe it'll be 75. It's something we don't control. So my personal recommendation is I'm not trying to maximize income for Social Security benefits. And then I think I'm missing one other question.
It was about the blip. So also what about changes in business structure? And there is a blip on the Social Security schedule.
Okay.
Can you contact the administration to raise it to what it really is for that blip year?
Okay. Okay. I think we talked about, so changes in entity structure, I think is the one part I didn't talk about. I absolutely love LLCs because an LLC can change how its structure on how it's taxed once every 5 years. You just have to comply with the rules of that entity structure. So for example, if you are a single member LLC and you do not have any other owners in for your business, you are not eligible to be a partnership because it has a rule of 2 or more owners. Likewise, if you have 2 owners of your LLC, you can never be a sole proprietor or Schedule C, really, because you're not following the rule of 1. You can make an exception argument if it's a husband-wife situation, but if you have a partner that's outside, a fellow owner that's you're not married to, you definitely have to have a partnership and you'll never be a Schedule C. Did that help?
Tamara, I think that was your question. Are you good?
Yeah, thanks, Alicia. Yeah, I just switched business structures and I know there's pros and cons to both. And so I was just curious to kind of get your take on all of that.
Yep. Awesome.
On the business structure, kind of what I've found, sorry, I'm now having a hot flash, which is why you're seeing my face going completely red. We were just talking about how you get more clothes on, take them off, more clothes on, take them off. Okay, anyways, just had a hot flash. From what I find as a general rule of thumb is that for LLCs, and I'm talking, well, it could be a single member or generally a single member LLC. If it's a single member LLC and we're looking at bottom line profits, when your bottom line profits are roughly $25,000 to $30,000, you're going to be better off being cash flow wise, better off in an S corp versus a Schedule C sole proprietor. If your bottom line profits of your business are less than that amount, you're going to be better off, pay less taxes if you just stay as a Schedule C sole proprietor. And it's actually pretty easy on an LLC to change how the entity is shaped. You don't even have to, how it's being taxed. You don't have to file anything with the Secretary of State. You just send in a form to the IRS, tell them how you want to be taxed, and then it just moves on. And I'm sorry, I flew through it. Normally when I do these, they do take an hour. And I have my whiteboard and I'm drawing, and it's just, Zoom meetings I fly through it too fast. You don't have as much of that dialogue interaction and constant questions.
Any tips on expense deductions that people miss?
Yes, and that's a whole other class module of what's deductible and what's not deductible and how far can you push it. One of the most common areas that I see people miss is the vehicle expense deduction. Generally, in order to be able to deduct the purchase price of a vehicle, it does need to be greater than 50% business use. You can deduct mileage. When you are deducting a vehicle or you're taking the vehicle costs, that's always the $1 million question on what's better, mileage or actual. And it all depends. It depends on how much you drive. It depends on what kind of vehicle you drive and how heavy your vehicle is that you drive. And is it better to buy or is it better to lease? Those are always the $1 million questions. So what I see people do often is they'll just take mileage and they overlook taking actual expenses on the vehicle. So when is it better for actual expenses and when is it better for mileage? On mileage, if you don't have, I call it a part-time business, for example, Mary Kay ladies, or you have a multi-level marketing type of company where it really isn't making much money, and you have a full-time W-2 job somewhere else, and this is just a part-time gig. If you're doing just a part-time gig and you have a W-2 job somewhere else, I recommend just taking your mileage because you're going to have a hard time convincing the IRS that more than 50% of your vehicle is used on that business when you have a W-2 job that you need to commute to. So the other area where I tell people to take mileage is if they drive really large amount of miles every single year and they drive the cheapest, oldest beater to get them from point A to point B. Construction workers this was back when we could deduct unreimbursed work expenses for construction people, but salesmen would also do this where they put a large amount of miles on their vehicle. They're putting, greater than 25,000 miles per year on their vehicles. And they drive, like I said, the cheapest, oldest hunk of junk that they can to get from point A to point B because they know it's an expendable car. You're better off taking mileage in that situation at the federal mileage rate. If you're someone who drives, has a full-time business, this is your main job, but you don't necessarily drive 30,000 miles a year in that vehicle, you drive something less and you drive a nicer vehicle, a more expensive vehicle. Then you're probably going to be better off taking actual expenses in your business for that vehicle. And what we will do is we would take all expenses of the vehicle for its gas, tire, oils, oil changes, your car registration, insurance, interest, licensing, everything that you have related to that vehicle for its cost. And then and this is also kind of generally the loaded question, if you like to drive a lighter weight vehicle, and the magic number is 6,000 pounds. If you don't drive many miles and you like to have an more expensive car and and you prefer to drive a lighter weight vehicle, leasing may be a good option if you don't drive many miles, because if you drive a lot of miles, you're going to get clobbered in the lease arrangement. They don't like heavy mileage on leases. A lease, for the tax deduction purposes, not accounting financial statement purposes, you deduct the lease payments as they're paid. The problem with buying a lightweight, really expensive vehicle is if you buy it outright, then depreciation gets limited. So when we had bonus depreciation, it was $18,000 was the maximum depreciation in year one. And if you have a $60,000 vehicle, and in year two, the maximum deduction you can take is, $3,200. It's going to take you a decade to be able to deduct a $90,000 expensive lightweight vehicle. So in those situations, and this is why you always see business owners with big, heavy vehicles. If you buy a big, heavy vehicle, weighs 6,000 pounds or more, these are your large SUVs, then you can deduct, under current regulations, 100% of the purchase price in the first year if you have sufficient profits to absorb it. So it can be as little as just a couple $1,000s, but if you structure things properly, you can get $100,000 tax deduction in the year if you really need it. So that is the biggest playroom, is dealing with the vehicles. And you can choose, you don't have to write off 100% of that purchase price of the vehicle in year one. That was done through bonus depreciation. Iowa doesn't allow it on that, but you can still have a different method of depreciation where you can take $25,000 on a heavier vehicle through 179. But the vehicles are the biggest one that people don't deduct, generally do not deduct their full value.
So Alicia, what do you see on the horizon? So what are you hearing coming out of Washington or at the state level? Any significant changes that you see on the horizon?
This last year has been extraordinarily challenging for us trying to keep up with the tax law changes. Because every time we thought we knew what the law was, it changed on us. And even this year in tax season, it changed, the laws changed halfway through the year, halfway through tax season. I do anticipate Biden has really been hard at work trying to reverse a lot of Trump's rulings or, executive orders. Mm-hmm. I do think that we will, I was reading out there, I do think that there will be another, there's always tax bills. It's their favorite thing to play with. So we will get tax bills out there. I anticipate that the corporate tax rate will increase for C corporations some. I'm hoping the 20% business income deduction doesn't go away, but I wouldn't be a bit surprised if it does go away to offset allowing employees to be able to deduct their unreimbursed work expenses again, because that was a very unfavorable element of the 2018 tax legislation that created that business owners only had to pay taxes on 80% of their net income and employees don't get to deduct any of their unreimbursed work expenses. That was a very pro-business piece of legislation that I wouldn't be a bit surprised if Biden and the Democratic Congress tries to negate and reverse elements of that. I don't know if they're necessarily going to negate and reverse it all, but I do think it is going to, I think capital gains will still stay where they are. Those have endured the administrations, both Republican and Democratic, for years. So I don't necessarily think they're going to mess with the capital gains rates. They will likely mess with the tax brackets, and the tax brackets may creep up, but I don't think it's going to be a full swing, completely undoing everything that was done in the Trump administration. I know there is talk of reeling back the estate tax deduction back to 5 million instead of 11 million. And there's talk about doing that. I think a lot of their legislation is going to be more geared towards the significantly wealthy. or the large corporations. I think that's where it's going to be geared towards.
Yeah, makes sense. I'm not saying I'm for it. It's just sort of the way of the world, right?
It is, and part of this, when it's going through, I just observe there are people, like I got a call yesterday from one of my customers that his parents are looking at selling or figuring out what they need to do with the family farm. And they're like, oh my gosh, estate tax, they're talking about eliminating, re-implementing the estate tax and repealing everything on that. And we don't want to give everything that we have for the family farm back to the government estate tax. And I looked at him, I'm like, well, okay, how big's the farm? 200 acres. How much is it roughly worth? $1 million at the most in the estate. You're fine. Even if they were talking of going back to the 5 million mark, you're not paying estate taxes. Don't get fretting, don't work up about it. Right now it's at 11 million. If they take it back where they're talking to 5 million, you're still fine. It's a mood issue. Now, talk to an estate planning attorney. They can talk to you about a trust and some other stuff, but as far as taxation of your estate, you're fine. So I think there's a lot of people that if they hear that the tax brackets are going up and now there's going to be a higher tax bracket in the, I don't know, go up to 36, 38% tax bracket rate. A lot of people automatically assume they're in those tax brackets when in fact, no, they're not. It takes a huge amount of income to get you up into those tax brackets. So.
Other questions for Alicia today? Okay, hearing none, I want to say thank you. Appreciate you taking the time out. Appreciate your knowledge and your sharing of that knowledge, and super excited for your 10-year work or company anniversary next year. So look forward to that.
Awesome. Thank you so much.
Thanks, guys. Thanks for joining, everyone.